Should I exit silver before it's too late? There is a number, a single price point, that almost nobody watching this video knows about. And once silver touches it, something happens that cannot be undone. Not a crash, not a correction, something quieter and far more permanent. Right now, silver is doing everything an asset is supposed to do. Rising demand, shrinking supply, industries that cannot function without it. Every signal says, hold on, keep stacking, do not let go. But there is a question almost no one is asking out loud. What if the very thing making silver valuable today is the same thing that could make it worthless tomorrow? Three forces exist right now, quietly, almost invisibly, that have the power to break silver's entire investment case. One of them is already in motion, and by the end of this video, you will know exactly which one it is and exactly what price changes everything. So stay with this until the very end, because the answer might change what you do with your money this year. Now, before we go further, I want to ask something a little personal. If you've been with this channel for a while, you already know we don't do hype here. We don't chase headlines. We sit down, we think, we look at the numbers honestly, the way a good advisor would for someone they actually respect. So here's my ask. If this channel has ever helped you see your money a little more clearly, ever made you pause before a decision, or feel a little more prepared for what's coming, would you do me the honor of subscribing? Not because the algorithm needs it, because conversations like this one deserve to keep happening, and that only works if you're here for the next one too. And I'd genuinely love to know, where in the world are you watching this from today? Drop your city or country in the comments. Some of the most thoughtful conversations on this channel have started right there in that comment section. Now, let's get into it. For thousands of years, silver carried one simple job. It was money. People traded it, saved it, and trusted it the way they trusted gold. But somewhere along the way, silver quietly took on a second job, and most investors never noticed the shift. Today, silver is not just a precious metal sitting in a vault. It is an industrial workhorse. It sits inside nearly every phone, every television, every computer screen on the planet. It powers solar panels, electric vehicles, and the massive data centers now running artificial intelligence systems. It shows up in medical devices that save lives every single day. In short, modern civilization cannot function without it. That sounds like good news for anyone holding silver. More demand should mean a higher price. And for years, that logic has held up well. But a sharp analyst does not stop at the obvious story. He asks the uncomfortable question that everyone else avoids. If silver depends so heavily on industry, what happens if industry stops needing it? This is the real question behind the title of this video. Not, is silver a good investment today? That question has been answered 1,000 times by 1,000 different commentators. The real question is sharper and far more dangerous to ignore. Under what conditions could silver lose its investment value entirely? Not a temporary dip, not a rough quarter. A permanent structural collapse that turns silver from a wealth-building asset into just another industrial material, priced the same way the market prices copper or aluminum. This distinction matters enormously, especially for business-minded people who think in terms of risk, not emotion. Gold has never needed an industry to justify its value. People hold gold simply because it is gold. It is trusted, scarce, and historically tied to wealth itself. Silver is different. A large part of its current strength comes from the fact that industries are buying it in huge volumes year after year. That is a strength today. But strength built on industrial demand can also become a weakness the moment that demand changes direction. This is exactly the trap that catches inexperienced investors. They see rising demand and assume rising demand is permanent. They see industries depending on silver and assume that dependence can never be replaced. History has shown again and again that no industrial input is irreplaceable forever. Materials get replaced. Technologies evolve. What looks essential in one decade can look outdated in the next. So this analysis will not be built on hope, and it will not be built on fear either. It will be built on probability. The goal here is not to tell anyone to panic and sell everything they own. The goal is to examine, calmly and honestly, the specific scenarios that could actually break silver's investment case, and to judge how realistic each one truly is. 3 such scenarios exist. They are not random guesses. They are the 3 forces that, if they ever became real, could push silver's price down so far that mining it would no longer make financial sense, and owning it would no longer make sense either. The first scenario involves the discovery of enormous new silver supplies, so large that the market becomes flooded with metal nobody expected. The second scenario looks towards something that sounds almost like science fiction, the mining of silver and other metals from asteroids in space. The third, and by far the most realistic of the 3, involves industries simply walking away from silver and replacing it with cheaper alternatives. Each of these scenarios will be examined honestly in the parts that follow, not with exaggeration, not with dismissal. with the same calm, analytical approach a serious decision maker would expect from a true risk assessment. Because in business, in investing, and in life, the people who succeed long-term are rarely the ones who panic at the first sign of danger. They are the ones who understand exactly where the real danger lies and where it does not. Silver may, in the end, prove to be one of the safest assets a person can hold, or it may not. But the only way to know for certain is to examine the threats directly instead of avoiding them out of comfort or convenience. That examination begins now. Every serious risk assessment begins with the most obvious danger first. For silver, that danger is supply. If the world suddenly found itself drowning in silver, the price would not just fall, it would collapse. So the first question worth asking is simple. How realistic is it that a massive new supply of silver could suddenly appear? To answer this, one must understand how silver actually reaches the market today. Most people assume silver comes from dedicated silver mines, the way gold comes from gold mines. That assumption is wrong. The majority of silver, more than 70% of it, does not come from mines built to produce silver at all. It comes out as a byproduct of mining copper, lead, and zinc. This single fact changes everything about how silver supply behaves. Because silver is mostly a byproduct, its supply cannot simply increase on demand. A mining company cannot decide to produce more silver the way a factory might decide to produce more units of a product. Silver output rises or falls based on decisions made about copper and zinc, metals driven by entirely different market forces. This makes silver's supply structurally rigid, almost frozen in place, regardless of what silver's own price is doing. On top of that, building a brand new mine from scratch, one specifically targeting silver, takes more than 10 years from discovery to actual production. That is not a minor delay. That is over a decade of lead time, during which prices, technology, and entire industries can change completely. Meanwhile, the silver that has already been pulled out of the ground and stored above ground continues to shrink, year after year, as industrial users consume it faster than new supply replaces it. So could explorers stumble upon some massive, undiscovered stash of silver hidden somewhere on Earth? It is not impossible. But modern mineral exploration technology is extraordinarily advanced. Companies fly specialized aircraft over vast regions, scanning the Earth for mineral signatures, then follow up with precise drilling to confirm what lies beneath. If a deposit large enough to flood the global market existed, it is highly likely it would have already been found by now. For this reason, this particular threat deserves only a small probability, somewhere in the range of 5 to 10%. It is not zero, but it is far from likely. The second threat sounds almost unbelievable at first, yet it has gained real traction among certain forward-thinking analysts and investors. Mining metals directly from asteroids in space. This is not pure fantasy. Scientists have confirmed that some asteroids contain enormous concentrations of valuable metals, including silver, gold, and platinum. In theory, a single mid-sized asteroid could hold metal reserves worth trillions of dollars at today's prices. If even one such mission succeeded at a reasonable cost, it could inject a staggering new supply of precious metals into the global market, instantly changing the economics of silver forever. But theory and practical reality remain worlds apart. The cost of launching a rocket, successfully landing on an asteroid, extracting raw material and transporting it safely back to Earth is enormous, likely running into hundreds of billions of dollars for even a single mission. Even the most optimistic timelines from credible space industry experts place meaningful asteroid mining decades into the future, generally not before the 2050s or 2060s, and even then, only in modest volumes at first. There is also a deeper economic safeguard built into this scenario. If asteroid mining ever did succeed at scale and supply genuinely flooded the market, prices would fall sharply. The moment prices fall far enough, mining additional asteroids would no longer be profitable. This creates a natural, self-correcting limit that prevents supply from spiraling out of control indefinitely. The market essentially polices itself, even in this futuristic scenario. Given the staggering costs, the multi-decade timelines, and the self-limiting nature of the entire concept, asteroid mining deserves an even lower probability than the discovery scenario, realistically falling somewhere between 2 and 5% in terms of meaningfully impacting silver prices within any relevant investment timeframe. Together, these first two threats, massive new earthly discoveries and asteroid mining, represent the kind of dramatic, headline-grabbing scenarios that sound frightening on the surface, but collapse under serious scrutiny. Neither one shows strong evidence of becoming a real near-term danger to silver's value. But there is a third threat, one far less dramatic, far more boring on the surface, and precisely because of that, far more dangerous to ignore. You said, with Part 3, start more unique, 700 words. The first two threats failed the test of realism. Now, they sounded dramatic, but the numbers behind them told a different story. The third threat is the opposite. It does not sound dramatic at all. It sounds almost routine. And that is exactly why serious analysts pay closer attention to it than to the other two combined. The threat is substitution. Simply put, industries replacing silver with something cheaper. This is not a new idea in economic history. Businesses have replaced expensive materials with cheaper alternatives for as long as industry has existed. Copper has been studied as a possible stand-in for silver in certain applications. Graphene, along with various nickel-copper plating techniques, has also been explored as a way to reduce silver use inside solar panel manufacturing. None of these alternatives perform as well as silver, but performance is only half the equation in business. Cost is the other half, and cost has a way of winning arguments over time. Here is the mechanism that makes this threat realistic. Silver is, without question, the best conductor of electricity and the best conductor of heat among all known metals. Nothing else matches it. This is precisely why industries continue using it despite rising prices. But every industry has a breaking point, a price level at which the best material stops being worth using, and the good enough material becomes the smarter business decision. Several industry analysts have pointed to a specific price range where this shift becomes serious, somewhere between $250 and $300 per ounce. Below that level, most manufacturers continue absorbing the higher cost because silver's performance advantage still justifies the expense. But once silver crosses into that range, the math changes. Engineers and procurement teams begin actively searching for alternatives, not because they want to, but because shareholders and budgets demand it. Even then, substitution does not happen overnight. Retooling a manufacturing line built around silver requires redesigning components, retesting performance, and retraining production processes. Multiple industry estimates suggest this transition would take somewhere between 5 and 10 years to fully execute across major sectors. This is not a switch that flips in a single fiscal quarter. It is a slow, expensive, and reluctant migration, one that companies undertake only when continuing with silver becomes financially unbearable. This combination, real but distant pricing triggers, combined with lengthy and costly transition periods, places substitution in an unusual middle ground. It is clearly the most credible of the three threats discussed so far, yet it remains far from imminent. For this reason, a realistic probability estimate would place it somewhere between 10 and 15%, meaningfully higher than the previous two scenarios, but still a minority outcome rather than an expected one. There is, however, an additional layer that most casual analysis tends to overlook entirely. Even if industrial demand for silver did soften over time, that does not automatically translate into a falling price. Markets rarely behave in such a simple, one-directional way. Consider what typically happens when any asset's price rises dramatically. Public attention increases, media coverage increases. Retail investors begin noticing the trend, often more aggressively than institutional buyers. If silver were to climb toward those higher price thresholds where substitution becomes serious, it is equally plausible that individual investors would rush in, driven by visible momentum and a fear of being left behind. Some analysts have even floated the possibility of central banks re-entering the silver market, something that has happened with gold repeatedly throughout modern monetary history. In other words, the same high price that pushes industries toward substitution could simultaneously pull new investment demand into the market, creating a counterbalancing effect that prevents the kind of clean, dramatic price collapse that headlines tend to predict. So where does that leave the overall picture? 3 distinct threats have now been examined in detail. None of them appear immediate. None of them appear overwhelming. Yet none of them can be dismissed entirely either. This raises an obvious and uncomfortable question. If none of these threats are currently active, why does the question, should I exit silver, keep appearing at all? That answer requires bringing all 3 threats together, weighing them honestly, and translating that analysis into something genuinely useful for serious, forward-thinking decision makers. 3 threats have now been placed under serious scrutiny. Massive new discoveries flooding the market, asteroid mining disrupting global supply, industrial substitution replacing silver with cheaper alternatives. Each one was examined honestly, without exaggeration and without dismissal. The result is a picture far less frightening than the title of this video might suggest, yet far too important to ignore completely. When the probabilities are placed side by side, a clear pattern emerges. The discovery scenario sits in the 5 to 10% range. Asteroid mining sits even lower, between 2 and 5%. Substitution, the most credible of the 3, still only reaches 10 to 15%, and even that outcome would unfold slowly over a 5 to 10 year window, not overnight. None of these numbers describe a market on the edge of collapse. They describe a market facing manageable long-term risks, the kind every serious asset carries in some form. So why does the question of exiting silver keep surfacing, even among experienced investors? The honest answer has little to do with silver itself, and everything to do with human psychology under pressure. Sharp price movements create fear. Fear creates urgency. Urgency pushes people toward decisions based on emotion rather than analysis. A disciplined business mind recognizes this pattern immediately. because it shows up constantly in markets, in negotiations, and in high-stakes decision-making of every kind. This is precisely where the real risk hides, not in some dramatic supply shock, but in the simple temptation to react to noise instead of evidence. Exiting an asset because of a sudden headline, a short-term price swing, or a viral prediction is not strategy. It is reaction. And reaction, historically, tends to cost more than it saves. For business-minded individuals and serious investors, the more useful approach is not asking, should I exit now, but instead asking, what specific signals would justify exiting later? This reframing changes everything. Instead of reacting to fear, one monitors actual triggers. A confirmed large-scale silver discovery, verified progress toward commercially viable asteroid mining, concrete industrial announcements of large-scale substitution away from silver. None of these triggers currently exist in any meaningful form. Until they do, exiting silver based on this video's title alone would mean abandoning a position based on a threat that has not yet materialized. There's also a broader economic context worth remembering. Currencies around the world continue to face long-term pressure from persistent monetary expansion. Throughout history, when confidence in paper currency weakens, capital tends to migrate toward assets with intrinsic, tangible value, gold and silver chief among them. This long-term pattern does not guarantee silver's future performance, but it does provide a structural tailwind that complements the supply-side analysis already discussed. None of this means investors should ignore risk entirely or assume silver is permanently safe. Markets evolve, technologies shift. What appears unlikely today can become more probable over time. The responsible approach is not blind confidence, and it is not panic either. It is continuous, calm observation, paired with a clear understanding of exactly which signals matter and which signals are simply noise designed to provoke a reaction. For now, the evidence points toward patience over panic. The threats are real enough to monitor, but not yet strong enough to justify abandoning a well-reasoned position. Serious decision-makers do not act on titles, they act on evidence. And the evidence, at this moment, tells a story far calmer than the question first suggested.